So I've had a few tech problems this morning. I was supposed to be trying to go live at 8 o'clock, a little bit later than advertised, but hopefully all sorted now. So if you've listened to one of these before, you might know I like to start with a quote, and this week's is: "Gratitude is the most exquisite form of courtesy." And that was from Jacques Maritain, the French philosopher. So before we get started this week, I wanted to say, first of all, a massive thank you. I had a tough week. One of the toughest I've ever had in the property business. Started with bad news, because life does that to you, right? And followed by a lot of difficult conversations. To a person, the people I spoke with are absolutely fantastic, rallying around, offering support and exceeding my expectations. And I wanted to say thank you to all of them. I also really appreciated the handful of people that I interacted with who had no idea about any of this, who took the time to thank me for the time and effort that they know goes into writing and delivering and reading this piece of content every week. I'm continually humbled by the kind words people use to describe it, and it really does help in keeping me going delivering this content. And to my number one fan, I wanted to give him a special shout out. He knows who he is. The way he shows his gratitude is touching and meaningful, and I appreciate you. So, we're only a few weeks away now from the next property business workshop on Tuesday the 1st of April, where our topic is due diligence. That's an entire day on due diligence, back after popular demand and expanded on our 2024 due diligence workshop, where we also covered two major other topics in the same day. We've got some fresh content and ideas, and we're going to be covering due diligence on business partners and suppliers, on deals, on lenders and borrowers, the health of companies and what you can and can't rely on from Companies House, liquidation, administration and receivership, due diligence on deals with limited time or information available, credit ratings and how they really work, financial promotions and the FCA, and a live due diligence exercise on some individuals and companies using some online tools. Tickets are live, they're selling already, they're at bit.ly/PBW and then a number 6. The super early birds have a genuine 25% discount on face value. When they're gone, they're gone. They're selling well. There's only one super early bird ticket left at the moment. It's still great value at the higher price, but if you've procrastinated, you might as well save the extra and book it now. So, welcome to the supplement machine. Was a bit calmer this week because there's only so many times the Donald can exceed expectations in any direction, I suppose. It was the week when the Bank of England Monetary Policy Delegation were in front of the Treasury Committee in Parliament, and so there are a few snippets which I'll cover in a suitable level of detail from all of that. Something to give us some idea of direction on rates and the economy overall as they see it, which, let's face it, even if it's not correct, it is what rate decisions are going to be based on. And then in the deep dive, I have a look at rental market index and also UK Finance's household finance review that came out this week, reporting on quarter 4 2024. I wanted to try and cut through the noise and find a balance between we just buy too many cappuccinos these days and the system's working, send more money, neither of which entirely capture reality. So in the real-time slot, Chris Watkin and the Property Market Stats Show get busy once again, and we get to ask the question we love to know the answer to: what is currently happening in the UK property market? As we get the report on week 8 of 2025, remember we run 1 week behind, but it's close to real time as we're going to get, we see the listings data continuing to revert back towards the mean after a white hot start in terms of numbers of listings. 2025 still remains the biggest start to the year for listings since 2016, if not before. Chris's data only goes back to 2017. It's still 8.2% higher than the 2024 number, which was, other than this year, the highest for listings in the sample, and 17.4% ahead of the pre-pandemic average. There's two, and only really two, real reasons I can think of for this. Firstly, the market is stable. So if you waited during 2023 and early 24, because the market obviously wasn't great, but the most nervous have had their doubts assuaged now, I'd argue. Secondly, there's a larger desire to get out of the market from soon-to-be ex-landlords. It can't be explained by there being more units, completions, repossessions, or anything else I can think of. But if you've got any other reasoning, please educate me and leave me a comment here or on my LinkedIn. 12% of stock continues to be reduced month on month. That compares to 2024's average of 11.9, and 2024 market looks similar to 2025 in terms of numbers of listings, as we've already said, but the 5-year average is 10.6% for reductions. So we've got more stock and we've got more reductions, both in percentage and absolute terms. The gross sales still sit between 21 and 22s, although now on the lower end of that, which is 22, because 2021 was really rocketing. 27,600 homes sold subject to contract in week 8, 27% higher than pre-pandemic levels. 22.3% fell through, still below the 24.2% 7-year average. But this is the highest fall through figure in week 8 of the year since 2016. Now, 1 week is not a canary in the coal mine, but this figure does need watching. Net sales look similarly outsized, 21,400, and 135,000 net sales so far in 2025 is 21% higher than the pre-pandemic 3-year average to date. I always like to give Chris a weekly shout out here because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with some great stats on a regular basis. Drop him a like, subscribe, all the rest of it, and some kind words for his content creation. If you're in the industry and you want a ghostwriter, that's his core business, give him a shout. The article gets published on the Property Industry Eye website and the video on his YouTube channel at Christopher Watkin. So we storm away from the real-time UK property market to the macro segment like a rugby player with the try line a few feet away. The first full week, so we have the Halifax House Price Index and accompanying report, the Bank of England Money and Credit Report with mortgage figures in and more, and I've got to talk about the PMIs too. And then we must close with the gilt and swaps market overview, of course, with a smatter of Bank of England testimony commentary in there this week as well. So Halifax report was somewhat dramatically announced by the press as usual. House prices down 0.1%, of course, the teeniest of slices. However, annual growth didn't change, still being stated at 2.9% by Halifax, the same as January's figure. Halifax also picks out a higher price rise in Scotland than there has been for the past 13 months. The head of mortgages at Halifax talks of a delicate balance in the market, and that seems pretty fair. With these stamp duty changes coming up at the end of the month, it's a popular line of analysis, but it is one that has merit. She also points out the difference between first-time buyer property prices, 2.4% up, compared to home mover price inflation, 3.7% up. Not data that I was aware they distinguish, and the first time I remember them mentioning it in one of these reports. Her argument is that the home movers are chasing the lower stamp duty, and indeed that's what I would expect. The first-time buyers have more to lose in more expensive locations, with the drop from 425k to 300k in terms of where stamp duty kicks in being a very expensive one indeed, because remember that's at 5%, whereas the home movers are motivated by the 2% between 125 and 250. So there's a lot more at stake for the first-time buyers. Now, it's possible because this index is heavily based on mortgages offered by Lloyds Banking Group, as you might imagine with the Halifax, which is about 15 to 20% of the market or so. And affordability is compromised with the extra stamp duty to consider on a percentage of the transactions. The Halifax position, which is in line with my own, is that prices will continue moderately at a slower pace than last year. However, with the spring statement weeks away, any significant changes to mortgage lending regulations are what we all need to watch to get a steer on the next few years. When the facts change, I will change my mind. So, transaction volumes still look healthy. 95,110 in January compared to 96,050 in December 2024. Now, those figures are seasonally adjusted and not the real number of transactions, which can be a bit confusing. Moving on to the Bank of England Money and Credit Report, the headlines always come from the mortgage numbers, 66,200 approvals, very steady, 300 down from December, which was 400 up on November. Remortgage approvals picked up a fair bit though, moving to 32,900. That has been festering around 30,000 over the last recent months. But I suspect some have seen rates going upwards and decided not to wait any longer. Consumer debt raced upwards, but January is that month in that department, so no particular alarm bells. However, the money supply kept on roaring forward for the second month in a row. The annual growth of M4, which is considered the best broad proxy for the money supply, is now 4.1%, which is the highest it has been since October 2022. Now, this really is one to watch. This is making a drop in inflation extremely unlikely and feeding into the narrative that I've been saying, stronger for longer, for some time now. It puts those thinking that we end the year in the UK with the base rate at 3.75 or 3.5. That's what US investment banks like JP Morgan and Goldman Sachs have been saying. And I think that's in the graveyard, to be honest, with these predictions. 4.25, my stab for base at the end of the year, looks as solid as it has done. The market this week shifted its expectation for bank rate in 1 year's time to 4.14. from 3.88 just a week before, basically yielding one whole cut on average of 0.25 in just the space of a week. The penny's dropping on this front. The big change was the money supply figure. How many articles about this, by the way? And yes, I understand it's not the most engaging topic of all, but it is significant and it does deserve airtime, which it's getting right here. How many articles in the press? 0. Precisely 0. Econotainment, or whatever you want to call it, focus on the con part. This is why the supplement exists. The whole argument centres on the correlation between money supply and inflation, which is strong, and one of the cornerstones of one of the major schools of economics. With this sort of money supply growth, inflation coming back to target looks unlikely, basically. The detail I'd like to draw out of the report, firstly, the effective interest rate on newly drawn mortgages, 4.51%, which is up 4 basis points on the month, and the outstanding stock of debt moved to 3.81, up 2 basis points. So that gap, which I'm keeping an eye on, widened by a small amount, but it has been closing a lot over recent times. Consumer credit growth remained at 6.4%, down from 6.5%. Looks large and unsustainable long term, but not meteoric. Credit cards have also lengthened their zero rate periods, which will no doubt be tempting many consumers back in. The money supply growth was the largest since January 2023, to put into context this particular metric. The bank prefers M4EX to M4, but M4 is much more widely available and accessible in my view. The October 22 date also makes more sense in many ways. The money supply had to shrink at that point to try and contain inflation, as it was busy rampaging in the double digits. So, mortgages healthy enough, remortgages looking okay, very low sustainable year-on-year growth, 1.8% currently, which means any changes to regulations that are coming won't blow things up in double quick time, but inflation looking unlikely to be tempered meaningfully under that 3% figure anytime soon. Regulars will know that I truly believe that's the target and the world that we live in these days for the moment. What is the moment? Could be the decade. So, PMIs time then. We had the flash figures, they were miserable, and the fingernails were jabbed into the side of the cliff for the economy according to the PMIs, which I must remind you have a very strong correlation to the growth figures. I'll lead off with construction because that one did make some headlines because it's absolutely cratered in just 2 months. The headline that was the one that was shared far and wide, fastest downturn in construction output since May 2020. The detailed parts, the real falls, are in housing and in civils activity. Commercials doing okay. Input inflation also went up at the highest pace since March 2023, which isn't ideal, but also isn't surprising. The print of 44.6 is quite horrible in the grander scheme of things, especially as it's only the second month in a row below 50, the neutral level. The Resi index is an anemic 39.3 and has been 5 months in a row like this. Civils at 39.5 was a big decline, and commercials, as I say, held up at 49.0. The pace of job shedding was modest but the sharpest since November 2020. There was also a huge drop in subcontractor usage. There's a chink of light in the construction report, however. Companies remain optimistic about their growth prospects for the next 12 months. There's the obligatory mention of payroll expenses, of course, which won't go away even when the rise has kicked in April. Manufacturing, just to cover the other major sector, printed 46.9. That's a 14-month low with steepest job losses since mid-2020. Output and new orders falling at faster rates. 5 months in a row of contraction now on this index. Retirees don't get replaced, but also jobs are actively being cut. And of course, the national insurance debate comes to the fore again. Now, services, the big E, and the resultant composite index remain resilient. The 16th of positive prints was achieved, 16 in a row, with the index still at 51. The long-run series average is 54.3, however. So once again, there was a strapline of the steepest pace of job shedding for just over 4 years. And once again, the national insurance rise rears its head. The composite index therefore hit 50.5, which is down from 50.6 last time out. 4 anemic months in a row after, well, the budget. The economic summary from the economics director there says, momentum has been lost, which I agree with. Demand conditionings are softening, that's both at home and abroad. Business confidence is the lowest it's been since December 2022, and that wasn't a happy month, let's face it, and still in the aftermath of the Liz Truss situation. And they also point to the 5th month in a row of job shedding. So unemployment numbers are not quite bearing this out just yet though, but let's see the next 3 months worth and how we get on, because there is a lag with those unemployment numbers being produced. So how about the Bank of England chatter and the gilts and swaps? Well, the governor's airtime this week focused on global economic risks from trade policies, tariffs, my favourite word. And there's clearly concern that Trump will drive the US out of other major international organisations such as the IMF, the World Bank and NATO, if that's what's happening. Now, I think we're still largely in a posturing stage, and ruling out any possible outcome would be silly. But at some point, if Trump does want to be taken seriously, he will need to put a head on a spike, most likely, and that's how he thinks. So, Bailey also noted that weakening demand could help to reduce inflation. Oh yay, inflation comes back under control just because there's no growth or negative growth. Super, eh? Catherine Mann, the hawkiest of the hawks, who switched her position to cutting rates as they've done more aggressively in the US, in spite of having similar inflation figures, reiterated that she thinks inflation is transitory and businesses will absorb the inflation hump rather than pass it through. We will see. She also stated that global market volatility weakens the case for a gradual approach to cutting interest rates. She's a rabid dove these days, and that's quite a switch in position. And the markets opened the week at 4.188% yield on the 5-year and closed at 4.248, so butting headroom with the top of my range. 6 basis points the wrong way, but we can live with it. The move of 26 basis points, as I've described already in the 1-year, only manifesting into a 6 basis point shift in the 5-year, is not a terrible result, nor is it a meteoric rise. Thursday's close at 4.266 correlated to the swaps hitting 3.969. Staying under 4, but a fair increase on last week, and in a complete opposite to last week, higher than both 1 month ago and 1 year ago. But there's not a lot in it still. It does foster the point there's quite a lot of stability around the 4% swap rate, with the weekly noise being more of a distraction than anything. However, it's going to be a cold day in hell before I stop reporting on it on a weekly basis, because any early warning indicators are worth their weight in gold, even if we have the next 500 weeks of not much news in this department. And let's face it, that's unlikely. So suit up, here comes the deep dive. First out of my 2 selections this week is the new Housing Pipeline Home Builders Federation report, just released on Q4 2024. The good news first, of course, the direction of travel is positive. 15% more residential units approved during the first quarter of 24 compared in the final quarter of 24 compared to Q3. So that limited the 2024 decline in approvals to 2%. Total permissions granted, 242,610. Not so bad compared to that target, remember. Well, not necessarily, but not all permissions get built out, remember. What the report highlights is something that really moves you when you consider it. How many approvals versus how many projects are achieved these days? 2,663 projects approved in Q4. That number used to be between 5,000 and 6,000 or more in boom times. The number of units hasn't badly materially changed. It's a bit lower, but not a lot. But if you ignore the years of wreckage that followed the great financial crisis, 09 to 15, say. But on fewer than half the projects, the same number of units are approved. Or, per project, the number of units is approved is 125% higher or so. Or, reframed, builders have to be more than twice the size they used to be on average to get planning approvals. The more sanguine interpretation, I think. I've used it as this week's graph since the picture tells a story. 3+ unit schemes in the private sector were actually down 15% year on year earlier in project numbers, but only 2% down in unit terms. So that increase was driven by the number of approvals on sites at 100 units or more. Now, whether this is a one-off boost due to Labour's attitude to bigger schemes and the willingness to force them through, with a fair few already in the pipeline, or whether this just persists, we will see. Social projects in unit terms were 56% up year on year, so that's the start of a win, perhaps. The approvals, however, are still 50,000 down in unit terms from 2020 and 2022, and 100,000 down on 2021's numbers across Great Britain. The series low for the moving average for Great Britain, 12 months, was Q2 2024. And things are about 2% better than they were in that number of unit approvals, but ultimately they're about 25% lower than the series average, which was established between 2016, after sort of financial crisis repair, and 2021. So this could see a relatively fast pickup because it has done in the past, but it will require favourable conditions, and I think we can safely say from the construction PMIs, which are 2 months more up to date, that hasn't come in Q1 2025. What we need to see here, in terms of more favourable conditions, would include planning permission probabilities. Well, that's being addressed, as we know. A steady upward market. Now, some of the analysts are on board with this now. There's plenty of reservations still being made in most commentary, so we could still see some improvement here. A drop in the price of credit would help, but the far bigger piece would be, if the price of credit is going to stay roughly the same for the near future, which is my position, with a small drop, which looks like a likely view for most bearish CFOs of house builders to take, help in the availability of credit. Help to buy specifically for new builds, or whatever such a new scheme might be called. Will we see something on that front by the end of the month in the spring statement? A broader policy shift would be the much mooted relaxation in mortgage lending regulations in general. I do wonder whether the temptation will be to tweak and therefore not have much impact, but we don't know enough yet about this government yet to really make that judgment call. The reality is we're a good 25% below post-referendum capacity for planning approvals before we consider the reality of delivery in the new and more regulated world after changes to building regs in the interim, including the Building Safety Act. Okay, so a fair conclusion is that there's a small amount of progress, nothing like enough to hit a delivery target of 300,000 homes a year. My hope is that also by taking a look at the UK household finance review, we can put into context whether households are in a position to participate in a building and housing market boom, because the house builders and the government would need them to, of course. This household finance review is published quarterly, and the opening gambit here is positive. Rising real wages and gradually falling interest rates have improved households' financial positions. That's a relief, because that's what I've been reporting for the past 18 months or so, watching the figures very closely. Confidence is low in the economy as a whole, but fair to middling on households' own financial positions with elements of positivity. Consumer spending is growing again on entertainment and household-related items. The mortgage market also bounced back, as we've noted, although the bounce has been fairly minimal, let's face it. Still, growth rather than shrinkage is positive. Then comes one of those sentences which leaves a clue for those of us who are tuned in and have been waiting for it. A tacit approval for a change in lending regulations. Mortgage regulations introduced over the past decade have increased the barriers to mortgage credit for some households more than others. Would-be buyers in London, where affordability is tightest, appear to have been disproportionately affected. The FCA's stated intention to simplify its lending rules could potentially offer some relief for households most impacted. UKF then points to more remortgages coming around in 2025, which will boost remortgaging activity, and savings continuing to build. Good news for deposits in general, and overdrafts and unsecured lending remains stable, it said in the report, most importantly with mortgage arrears now on a downward path. The increase in possession cases was known after an increase in arrears. That had been the story for the last couple of years, and it's noted that all this remains low by historical standards, which it does. And whilst cases will increase during 2025, the problem does not appear to be endemic. So more possession cases, fewer arrears cases. And it's ultimately possession cases that come from arrears cases the year before. As a general rule, there's a bit of a lag. Right? So the economic report follows, and largely what they've said is what we already know. A flat second half of 2024 with a nice surprise in December, meaning that the economy didn't contract. They do point to an unexpected jump in inventories in December and recognise this as a volatile component to GDP, which can have the impact that it did. In Labour's case, good timing would be a fair summary. UK Finance's take is that wages have now caught up with the inflation shock of the previous wages have caught up with the inflation shock of the previous years. Now, I'm not sure that's as scientific as it sounds, as difficult as it was for me to say, although real wages do indeed look okay as we continually monitor them via the RHDI metric. That's the real household disposable income, one of my favourites. There's then discussion of tariffs, how they impact Bank of England decision making. They're inflationary is the key point, and so that's a concern to lowering rates. However, you also see that in the US, the real use of them is to start and quickly conclude negotiations rather than actually slap those extra tariffs on. That sort of works until it doesn't work, of course. In the past week, we've seen Mexico move very quickly when the 1 month deadline expired, for example. But Trump brings risk and volatility. Denying that would be silly. Whether anyone thinks he's doing the right thing or whether they agree that the end justifies the means or whatever, or not, he brings risk and volatility. So, the remainder of the report is a bit more positive than some of the week-to-week and month-to-month figures that I've been seeing. Although it's important to note that confidence overall has improved in the consumer anyway in February's figures, it still remains well below the yard on, but it is going in the right direction. There's a summary to finish us off because I've drawn out all the other major relevant points. Improving household sentiment, but the feeling of fragility is expected to persist. Spending patterns are showing a gradual improvement in disposable income. Second-hand stores have been growing very quickly, but that's slowed down. Loan data shows purchase loans up 15.6% in number, remortgages down 9% in number for 2024. Prices up 3.6%, that's the number that UK Finance use, 2.3% fewer mortgages in arrears year on year, and gross mortgage lending up 7.3%. Mortgage activity recovering was particularly prevalent in the south. It seems strange given the affordability pressures, but they explain it by characterising 2023 as full of won't buys rather than can't buys. Wouldn't buy when the prices were on the slide and rates were very high, rather than couldn't afford it. They then focus on mortgage lending rules affecting London and the South East disproportionately. It's the 15% of all lending at multiples higher than 4.5 times income, which is the choke point, leading to deposits needing to be 2.5 times household income, up from 1.9 times in London before the rule changes. I'm not so sure I can see a geographical exception being made by the FCA, however, so I'm curious to know where they're sort of going with this point. There is a note that this is all an improvement on 2023, but there's still work to be done to get back to parity for the lending market generally, which all the figures do bear out. There's an interesting point about buy now, pay later, reducing the need or the usage of overdrafts. Credit card debt lending is growing, but the continued trend of 0% balance cards means only about 50% of balances bear interest, compared to 65% in 2011. And it's a very steady trend line down for both upwards for the balance growth, downwards for the percentage bearing interest. So in old money, you could say 14 years ago, 2/3 of people were paying interest and 1/3 of people were benefiting from that by not paying interest. Whereas now 50% of people are not paying interest and 50% of people are, so it's more like 50-50 rather than 2-1. Quite a change, and that can't go on forever, of course, that trend. Possessions up, arrears down, we've already said. Older arrear cases being pursued. You can turn off the klaxons on repossessions, although they are happening at a larger rate than they have done for a number of years. And then the sensible conclusion at the end of the report is, at the aggregate level, the household sector looks to have navigated the considerable cost and rate pressures seen since the end of 2021, with only very limited impact on meeting their credit commitments. Although there is a risk that a weakening labour market could derail this, the outlook is for further improvement as these pressures continue to recede through 2025. Put another way, we've got through a pretty strong set of post-pandemic challenges here. However, I am concerned about the labour market side, as that's where the risk currently sits, taking everything else into account. Okay, so one reminder to book your tickets for the 1st of April Property Business Workshop, Due Diligence. We will guarantee the most comprehensive day on due diligence has ever been delivered in the property space. bit.ly/PBW6, and above all, please remember to keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030. The risks around at this time, while they feel significant, the geopolitical ones, are far less meaningful to the UK housing market than the risks have been for several years. Of that I have no doubt. Good luck.